The first mortgage statement most first-time buyers receive looks like a document designed by someone who didn't want it to be understood. Principal balance, escrow account, impound account, outstanding interest, unapplied funds, year-to-date interest paid. None of it is explained. It's just there, in columns and rows, with a payment due date at the top and a phone number at the bottom in case you have questions, which you almost certainly do. Here's what every number on that statement actually means, why it matters, and what you should be watching for every month to make sure your mortgage is doing exactly what it's supposed to do. Your monthly mortgage payment is not one thing. It's typically 4 separate things added together, which is why the industry uses the acronym PT, principal, interest, taxes, and insurance. Principal is the portion of your payment that reduces your loan balance. In the early years of a 30-year mortgage, this number is small, sometimes less than 15% of your total payment, and it grows every month slowly as the loan amortizes. Interest is the cost of borrowing the money. It's calculated as your current loan balance multiplied by your monthly interest rate. Because your balance decreases slightly with every payment, the interest portion of each payment also decreases slightly, and the principal portion increases by the same amount. This shift is gradual, but it's happening every single month. Taxes are your property taxes, collected monthly by your lender and held in escrow until they're due, typically twice a year. Your lender collects 1/12 of your estimated annual property tax bill with each payment. If your property taxes increase, which they do in most markets over time, your monthly payment will increase to match even if your interest rate hasn't changed. Insurance is your homeowner's insurance premium, also collected monthly and held in escrow. Same logic as taxes. 1/12 of your annual premium collected each month, paid out by the lender when your policy renews. If you put down less than 20%, PMI is a 5th component. It appears as a separate line item and will continue until you've built enough equity, typically reaching 20% of the home's original value, at which point you can request its removal. The escrow account is where your lender holds the tax and insurance portions of your monthly payment until they're due. It's not your money in any practical sense. It's a holding account that your lender controls and disburses from on your behalf. Every year, your lender conducts an escrow analysis, a review of what was collected versus what was actually paid out. If they collected more than was needed, they'll send you a refund check for the surplus. This is the most common reason a mortgage payment increases without a rate change. Your property taxes or insurance premium went up, your escrow analysis revealed a shortage, and your lender adjusted your monthly collection to cover the new amounts. It isn't a mistake, and it isn't optional. The escrow account balance on your statement is the current amount being held. Watch it. If it's significantly lower than the combined annual taxes and insurance divided by 12 times the number of months since your last escrow analysis, something may be off. If it's significantly higher, you may be due a refund at the next analysis. Not all mortgages have escrow. Some lenders, particularly for buyers who put down 20% or more, allow borrowers to waive escrow and pay taxes and insurance directly. This gives you more control, but also more responsibility. If you're managing taxes and insurance directly, set up a dedicated savings account and fund it monthly so you're not hit with a lump sum bill twice a year. Your principal balance is the current amount you owe on the loan. It's the number that decreases with every payment. Slowly at first, then faster as the amortization schedule shifts. The amortization schedule is the full breakdown of every payment over the life of your loan, showing exactly how much goes to interest and how much goes to principal each month from payment 1 to the final payment. Most lenders provide this document at closing. If yours didn't, ask for it. It's important information. Here's what the amortization schedule reveals that most first-time buyers never look at. On a $300,000 30-year loan at 6.8%, you'll pay approximately $385,000 in interest over the full life of the loan, nearly as much as you borrowed. Most of that interest is front-loaded. In the first year, less than $3,000 of your payments go toward principal. By year 15, roughly $7,000 a year goes to principal. By year 25, the split flips almost entirely to principal. This front-loading is why extra principal payments made early in the loan have a disproportionate impact. Every additional dollar paid toward principal in the first 10 years eliminates future interest that was calculated on that balance. A $100 extra payment toward principal in month 1 of a 30-year mortgage doesn't just reduce your balance by $100. It eliminates all the interest that would have been charged on that $100 for the remaining 29-plus years of the loan. Look at your statement monthly and watch your principal balance decrease. It's slow at first, but watching it move is one of the clearest indicators that your mortgage is working the way it's designed to work. Beyond understanding what the numbers mean, here's what to actively monitor on every statement you receive. Payment application. Every payment you make should be correctly applied to principal, interest, and escrow in the amounts shown on your statement. Occasionally, lenders make errors. If a payment doesn't appear on your next statement or is applied incorrectly, catch it early. Undocumented payments and misapplied funds are rare, but they happen, and the earlier you flag them, the easier they are to resolve. Extra principal payments. If you're making extra payments toward principal, verify on each statement that the additional amount is being applied to principal reduction rather than being treated as an early regular payment. Not all lenders handle this the same way. Most have a specific process, a separate payment field, a written request, or a specific payee designation for designating extra funds as principal payments. Follow your lender's process exactly. Escrow shortages and surpluses. Your annual escrow analysis will arrive as a separate notice. When it does, read it. If there's a shortage, understand why. Was it a property tax increase? An insurance premium increase? Knowing the reason helps you anticipate whether it will happen again next year. Year-to-date interest paid. This number lives on most statements and is important at tax time. Mortgage interest is deductible for itemizers, and the statement total may differ slightly from your year-end tax form. Form 1098 due to timing differences. Keep your statements or track the running total so you have a reference if there are discrepancies. Payoff amount. Different from your principal balance, the payoff amount is what you would need to pay today to close out the loan entirely, including any interest accrued since your last payment. If you're ever refinancing or considering selling, this is the number you need, not the balance. Your mortgage statement is not a document to file and forget. It's a monthly report on the largest financial instrument most people will ever carry, and it contains real information that tells you whether your loan is working correctly and how your equity is building over time. Understanding it doesn't require a finance degree. It requires knowing what each line means, which you now do, and checking it monthly with the same attention you'd give any other financial account. The principal balance going down, the escrow staying funded, the interest portion of each payment gradually shrinking. These are the signs of a mortgage doing exactly what it should. Now you know how to read them. Your mortgage statement just became a document you can actually use. Like this video if it helped, and subscribe, because there's a lot more in the home buying process that deserves the same treatment.